Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Alliant Energy Corporation Annual Report. Alliant Energy Corporation offers a diverse range of businesses and services that cater to various customer needs. At the core of their operations are regulated electric and natural gas services provided to retail customers in select markets across Iowa and Wisconsin. The company's IPL segment serves wholesale customers in Minnesota, Illinois, and Iowa, while its WPL segment caters to wholesale customers in Wisconsin. In addition to electricity generation and distribution, Alliant Energy also provides natural gas distribution and transportation services to retail customers in select markets. They serve a wide range of industries, including farming, agriculture, industrial manufacturing, chemical, packaging, and food. Furthermore, the company offers freight brokerage services, wind turbine blade recycling services, and operates a rail-served warehouse in Iowa. Alliant Energy also owns and operates various infrastructure assets, such as a short-line rail freight service in Iowa, a Mississippi River barge, rail, and truck freight terminal in Illinois, and holds interests in a natural gas-fired electric generating unit near Sheboygan Falls, Wisconsin. The company's portfolio also includes a wind farm located in Oklahoma. Alliant Energy Corp's stock price has seen a notable increase in the past year due to several positive news events and strong financial performance. The company reported robust fourth quarter and full year 2025 earnings, exceeding analyst expectations with operating earnings of 60 cents per share and adjusted earnings of $3.22 per share. The significant data center demand and load growth have also contributed to the stock price increase. Alliant Energy announced a transformative shift in its business model, fueled by approximately 3 gigawatts of data center demand, which is projected to increase electricity demand by 50% by 2031. The company secured 4 major data center customers, including QTS, Google, and Meta. Favorable regulatory approvals have also played a crucial role in the stock price increase. Alliant Energy achieved significant regulatory milestones in 2025 and early 2026, including approvals for major generation and energy storage projects, individual customer rate agreements for large data centers, and a unanimous settlement for the 2026-2027 rate review. In addition to these factors, Alliant Energy's consistent dividend increases have demonstrated its commitment to shareholder returns. The company increased its quarterly dividend to $0.535, an annualized $2.14 from $0.51, marking the 22nd consecutive year of dividend increases. The company's strategic capital investments and future guidance have also contributed to the stock price increase. Alliant Energy's 4-year, $13.4 billion capital plan is set to support substantial future electric demand, and the company affirmed its ongoing EPS guidance for 2026 at $3.36, $3.46, reinforcing its long-term growth trajectory of over 6% compound annual earnings growth. Alliant Energy Corporation maintains a market capitalization of $18 billion, broadly in line with the industry peer group. Alliant Energy Corporation trades at a higher price-to-earnings ratio of 22 times and a higher price-to-book ratio of 2.49 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 69% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. Although shareholder equity has increased, the share count has risen while revenue is declining. This raises concerns that equity growth may be driven by dilution rather than business performance. The sustainability of the business model remains unproven. The company have a dividend yield of 2.9%. The income statement shows that the company revenue have been declining annually even though operating income have been improving. Although the drop in revenue is concerning, we can tell that management have been able to reduce cost. The primary drivers of revenue growth or decline for a company can be complex and multifaceted. However, based on the provided summary, it is clear that certain segments are experiencing significant changes in their revenue streams. Electric utility revenues have been a major contributor to the company's growth, increasing by 6.3% from 2024 to 2025. This growth can be attributed to various factors, including IPLS corporate services billings and sales credited. On the other hand, gas utility revenues have declined by 0.8%, while other revenues have decreased by a significant 45.7%. A closer look at segmental analysis reveals that WPL's revenue from ATC billings has increased by $10 million from 2024 to 2025. This increase is a notable contributor to the company's overall revenue growth. In addition to these factors, changes in commodity contracts and capital purchase commitments have also impacted the company's financial performance. Furthermore, tax reform and state income taxes have affected the company's regulatory assets and deferred tax liabilities. Overall, it is evident that revenue growth or decline is driven by a combination of factors, including segmental performance, commodity contracts, and tax reforms. The net income and profit margins of the company underwent significant changes between 2023 and 2025. Initially, there was a decrease in net income by 14% from 2023 to 2024, which can be attributed to various factors such as weather effects on utility sales volumes, cybersecurity incidents, and economic conditions. This decline was also reflected in the profit margins, which decreased by 10%. However, the trend reversed in 2024-2025, with a 13% increase in net income. This growth was largely driven by an increase of $153 million in utilities and corporate services. Despite this overall improvement, there were still some fluctuations in net income across different segments, with decreases ranging from $34 million to $120 million. In terms of profit margins, the company experienced a slight decline of 1% from 2024 to 2025. However, there was an increase in profit margins for certain segments, such as electric 2-3% and gas 10-14%. These changes can be attributed to various factors including changes in market conditions, regulations, and MISO's seasonal resource adequacy process. Overall, the net income and profit margins of the company were influenced by a range of external factors, including weather effects, cybersecurity incidents, economic conditions, and supply chain issues. Despite some fluctuations, the company was able to achieve growth in certain segments, indicating resilience in the face of challenges. The company's financial performance indicates a strong ability to generate cash from its core operations. According to various sections of the report, the net cash flows from operating activities for 2025 are consistently positive. On page 53, it is reported that this figure stands at $1,169 million, while on page 59, it is noted as $286 million. Although there is a slight variation in the amount, all reports confirm that the company is generating significant positive cash flow from its operating activities. This trend continues with net cash flows of $836 million and $529 million reported on pages 65 and 126 respectively. Overall, these figures suggest that the company is successfully managing its finances and generating substantial operating cash flow in 2025. The company's debt level and interest expenses have undergone significant changes over the past few years. On one hand, the total long-term debt has decreased from $12,125 million to $9,925 million, indicating a reduction in debt levels. However, this decrease is offset by an increase of $600 million in long-term debt from 2024 to 2025. In terms of interest expenses, there has been a significant increase over the years. The interest expense was $143 million in 2025, compared to $134 million in 2024, indicating a slight increase. However, when looking at the trend, interest expenses have increased significantly from $34 million in 2023 to $57 million in 2025. Despite the decrease in total long-term debt, the company's interest expenses have not decreased proportionally. In fact, there has been a significant reduction in interest expenses only in 2025, with a $1 million reduction compared to previous years. Overall, while there are mixed signals regarding the company's debt levels and interest expenses, it is clear that the company's financial situation is complex and requires careful analysis. The performance of various segments within the company has been analyzed. Two segments stood out as top performers in terms of electric utility revenues. The IPL segment generated $1,896 million in revenue, while the WPL segment earned $1,801 million. These figures indicate a strong financial performance from these two segments. On the other hand, the other segment struggled significantly, recording a net loss of $48 million. This underperformance is a concern and warrants further investigation to identify areas for improvement. The contrast between the well-performing IPL and WPL segments and the poorly performing other segment highlights the need for targeted strategies to address specific business challenges. Acquisitions and divestitures. Overview: the company has made several significant acquisitions in the energy sector, expanding its portfolio of assets and capabilities. Notably, WPL acquired wind development assets from an affiliated subsidiary of AEF, as well as a 277 MW wind farm in Columbia County, Wisconsin. Additionally, IPL acquired various energy storage projects, including those at Wever Solar Facility, Lansing Generating Station, Golden Plains Wind Farm, and Whispering Willow North Wind Farm. The company also acquired natural gas-fired EGUs, such as the Cedar River Generating Station, Bobcat Energy Center, and Burlington Generating Station. Furthermore, WPL entered into agreements to purchase a partial ownership interest in West Riverside. These acquisitions demonstrate the company's commitment to expanding its renewable energy capabilities and increasing its presence in the market. On the other hand, the company has also made several divestitures, including exiting the steam business subsequent to December 31, 2025, and selling eligible renewable tax credits under the Inflation Reduction Act of 2022. Additionally, IPL sold certain non-utility subsidiaries and transferred future tax credits from such projects to other corporate taxpayers. The company expects to transfer all eligible renewable tax credits to other corporate taxpayers in the near future. Overall, these acquisitions and divestitures reflect the company's strategic efforts to optimize its portfolio and position itself for long-term success in the energy sector. Alliant Energy Corporation has a history of paying dividends to its shareholders. The company has consistently announced increases in its targeted annual common stock dividend, with the most recent increase being a 5% boost to $2.14 per share for 2026. This is evident from multiple pages within the provided text, including page 28 and page 35. The company's dividend payments have been substantial, with figures ranging from $184 million in 2023 to $521 million in 2025. While there are discrepancies in the reported amounts across different pages, it is clear that Alliant Energy has prioritized paying dividends to its shareholders. In contrast, there is no clear information on share buybacks by the company. Despite the extensive details provided about dividend payments, the text does not mention any instances of share repurchases or buybacks. There are valid concerns about inventory buildup and supply chain disruption in the energy sector. The primary concern is the potential delay or non-approval of pipeline expansions for new gas-fired generation, page 16. This could lead to a shortage of natural gas, which is a crucial component for electricity generation. Regulation of oil and gas production may also impact the upstream supply of natural gas, page 18. Furthermore, existing contracts for natural gas and coal supply and transportation may not be fulfilled due to various reasons, such as financial or operational problems caused by external factors like natural disasters, economic conditions, labor shortages, or cyber attacks, pages 22-23. Additionally, Federal Reserve policies and actions, currency concerns, inflation, economic downturn, or uncertainty can also cause disruptions in the supply chain. The planned continuation of coal operations at Columbia, Units 1 and 2 through 2029, page 76, indicates potential delays in transitioning to alternative energy sources, further exacerbating the issue. These factors collectively contribute to a high risk of inventory buildup and supply chain disruption in the energy sector. That concludes the financial summary for Alliant Energy Corporation. Feel free to comment below, and I will be happy to answer them when possible.